Are you aware of one of the most popular questions asked in parties and social gatherings? It is, can you tell me the one best investment for me to buy right now? However, not many people are aware that only one-third of investment returns come from selecting the best investment. So where do the rest of the returns come from, you wonder? Well, two-thirds of investment returns come from the right asset allocation between the different asset classes. So, what is an asset class, you ask? An asset class is a group of investments that have similar risk-return characteristics. So, equity is one asset class while debt is another. There are five main asset classes, namely equity, debt, gold, commodities, and real estate. Asset allocation is the division of money between different asset classes at a point of time. The right asset allocation is responsible for the majority of returns that investors make. However, while simple in theory, asset allocation is not easy to follow as investors get swayed by greed and fear. It is thus important for investors to create a set of scientific rules that have worked in the past and follow them diligently. Hi, this is Prashant Saraf, and you are on my channel Blueprint Investments. I am on a mission to arm 1 lakh investors with the knowledge, strategies, skills, and tools to create life-changing wealth for themselves and their families. Coming back to the video, investors need to create a set of rules for asset allocation that generate superior returns. Two types of asset allocation that investors have followed with success in the past are static and dynamic. As the name suggests, dynamic allocation is the asset allocation where the investor changes the proportion of various asset classes based on their attractiveness vis-a-vis each other. On the other hand, static allocation is when the investor decides to keep the proportions of the assets at the same level throughout their life. The difference is that rebalancing is done to a set proportion in static allocation, while it is done to an evolving proportion as per dynamic allocation. Rebalancing creates value only when it is done infrequently. This is because markets tend to trend in one direction for some time. As a result, the right frequency to do asset allocation is not more than once or twice a year. Different assets grow at different rates over the years. So over a time period, a set asset allocation can change from the base level set. Let's look at static asset allocation first. As an example, take an investor who has invested 60% in equity and 40% in debt in year 1. Now, if during the year equity grows at 30% while debt only grows at 5%, the investor will find that the asset allocation has changed to 65% equity and 35% debt. As we have already seen in the video on asset class and sub-asset class, each asset class has particular features that make it desirable to hold at certain times. Different asset classes play different roles in a portfolio. To understand the role various asset classes play in the portfolio, it will be helpful to compare them to the role different types of food play to nourish the human body. For instance, protein allows the body to grow and replenish itself. The same role is performed by equity in your portfolio. Similarly, carbohydrates provide your body with the daily energy needs. The same role is performed by debt as it provides steady income to your portfolio. Fats act as a store of energy that the body can turn to in times of stress. In a similar vein, gold and property act as a refuge of last resort to protect the portfolio in uncertain times. Vitamins take care of any deficiency in the body. The same role is performed by commodities when the other asset classes cannot help the portfolio to withstand inflation. Like proteins and carbohydrates that are the main foods that the body needs to nourish itself, in the same way, debt and equity are the mainstay of one's portfolio. However, this does not mean that the other asset classes do not have a role to play in the portfolio. While they may deserve a lower allocation, their role is still important to enhance the risk-return profile of the portfolio. It should also be noted that based on peculiar circumstances related to the business cycle, they may deserve an outsized role at certain times during the investor's journey. Once an investor evolves and realizes that asset allocation needs to be changed with time, they move on to dynamic asset allocation. Now the big question is, what are the factors that change this desirable mix with time? The factors that decide the asset mix at a point of time in dynamic asset allocation can be divided into internal and external. The internal factors that decide the asset mix in dynamic asset allocation are related to the investor's own internal circumstances, like the risk profile and the need for income. So, the first important factor that can make changes desirable is the risk profile of an investor. Let's consider that an investor is risk averse as he cannot stand with volatility. Now, compared to an investor who can stand volatility, he should have less allocation to fluctuating assets. For such an investor, the allocation to debt and property is more and equity, gold and commodities is less. Now let's assume that the first investor needs the investment income for running his expenses. Then his allocation to equity will naturally reduce further. The external factors that determine the asset mix in dynamic asset allocation are related to the relative attractiveness of different asset classes at a point of time. Notice that we have still not spoken anything about the attractiveness of different asset classes. There are two main aspects to consider while judging the attractiveness of an asset class at a point of time. The relative valuation of different asset classes compared to each other and compared to their own history is very important. By this reckoning, equity and debt are overvalued and gold and commodities are undervalued. Each asset class outperforms in some stages of the business cycle and underperforms in others. A business cycle has 4 stages: rebound, inflation, deacceleration, and trough. Equities do best in the rebound, commodities do well in inflation, debt does best in the deacceleration, and gold does best in the trough. So, the current cycle favors debt. Since the business cycle is currently in the deacceleration phase, debt becomes the preferred asset class. The valuation of an asset class gives an idea of how far the asset class can correct. The business cycle, on the other hand, informs what is likely to happen in the next 12 to 18 months. Both these aspects taken together inform an investor of the attractiveness of an asset class and constitute the external elements which an investor needs to consider. The attractiveness of an asset class and the risk profile of an investor need to be both evaluated while calibrating the asset allocation. To understand dynamic asset allocation model in a simple yet concrete way, let's take an example. Imagine that there are 2 surfers who have come to an ocean resort. Now imagine that one of them is a newbie who has an old surfboard borrowed from a friend. Here, the new surfer represents an investor with a lower risk appetite and a short time horizon. This is because he is risk averse with a need for income, while the other surfer is an experienced hand with the latest surfboard. The old surfer, on the other hand, represents an investor with a higher risk appetite and a longer time horizon. This is because he can take risks and is patient. Now imagine that the weather on day 1 is calm. In this weather, with hardly any waves, both the surfers may be able to navigate the seas quite well. However, if the weather on day 2 is stormy, the new surfer is unlikely to do well and would be better served by being closer to shore where the waves are less fierce. The weather here represents the market regime, whether volatile or stable. Similarly, a risk-averse investor cannot sail through market volatility and is best served by keeping low allocation to volatile assets, while a more aggressive investor with experience can handle tough weather with more ease. What is important to understand is that just like weather can't be predicted with 100% accuracy, so too we can't predict whether the market will be calm or stormy with certainty. All the investor can do is to assess both the internal circumstances and external environment and plan the asset allocation to take care of all contingencies, whether rain or shine. So the answer to the most often asked question is another question. If I told you, would you sell everything you own and put 100% of your money in that investment? If not, then what difference will it make to you to know the best investment? Shouldn't you figure out your asset allocation first? In short, answering the asset allocation riddle will be more helpful in increasing returns, reducing risk, and achieving your goals than answering the right investment riddle. With that, we complete our video on asset allocation.